because like the interest rate topic has been a very hot topic for the past 1-2 years. Okay, and especially earlier in the year, there were talks that they are going to cut the interest rates in June. Okay, but now it's like pushing further and further back, like September or even December. So I think there's been new developments over the past 1 week. So that's why I think today's topic is like very spot on, right? Okay. So without further ado, I will pass on the time to Alice from PIMCO. Okay, round of applause, please.
Morning, everyone. Very pleased to be here. Thank you for spending your Saturday morning with us. I think, yes, the slides are right up here. While we are getting this started, can I have a quick show of hands for the audience here? How many of you have heard of PIMCO? Okay, great. I see a number of hands. So it sounds like you guys have heard of us. That's great. Maybe for those that may not know us as well, I just wanted to spend maybe just 1 or 2 minutes to give a brief introduction of who we are. PIMCO is a US-based asset manager. Our headquarters is in California. We've been managing monies for our investors since 1951. It's like 1971. So we've actually had more than 5 decades of experience in managing assets for our investors globally. We are currently managing close to $2 trillion in AUM for investors. And we are known in the asset management industry for our expertise in macroeconomic forecasting as well as managing bonds. And so very excited to be here to talk about our macroeconomic view as well as our flagship bond fund, the PIMCO GIS Income Fund, and in this setting. So why are we known for macroeconomic expertise? I think one thing that sets PIMCO apart from a lot of other asset managers in terms of how we forecast the macro trends in the markets is that we don't just rely on having one maybe senior economist or CIO to set the direction for the firm. We believe in what we call the power of collective thinking. So what we do is that we aggregate a lot of intelligent people that manage monies at PIMCO, and we actually gather every quarter at our headquarters in Newport Beach, and we will discuss and debate ideas and discuss and again to see what's going on in the economy, what's going on in the markets to really decide what is the best course of action. So, and at the same time, not only do we fly in all of our investment professionals to California, we also invite external experts to join us at our economic forums to really provide additional insights and guide our thinking. So we actually assembled, I would say, like an Avengers board of economists and policymakers in the financial world. So, for example, the chair of our global advisory board. So these advisory board members join us at our economic forums. The chair of the board is none other than Ben Bernanke. So Dr. Ben Bernanke was the former chair of the US Federal Reserve, and he presided over the US Fed during the 2008 global financial crisis. So obviously, a gentleman that has a lot of expertise and insights in the inner workings of the Fed. And aside from Ben Bernanke, you can see other members of our advisory board include very well-known individuals. I will just maybe pick out 1 or 2. For example, Gordon Brown, who was previously the UK Prime Minister. Right? So we don't just think of the US, we also want to have global insights. We want to know what's happening in the UK, in Europe as well. So global expertise. And aside from these 5 members of the board, we also routinely invite other experts as guest speakers to our forums as well. So this is very briefly why we think that our economic forecasting process has been very robust and has really added a lot of value to how we manage portfolios and add additional value for our investors. So with that said, what is our current macro outlook? What do we think is happening in the markets today? I would say that right now, in terms of our view on the markets, PIMCO is slightly different, I would say, from the average consensus. So I mentioned just now that we have quarterly economic forums. The latest economic forum that we've had, the theme coming out from our discussions was that of diverging markets diversified portfolios. So we think that right now markets are actually diverging. We see that in particular, the US looks to be on a different path as compared to a lot of the other developed markets globally. We see that in the US, if you've been following the numbers, the economy, the inflation numbers in the US have continued to remain remarkably resilient. If you look at the latest numbers that's come out over the last week, the US actually printed their inflation numbers at 2.7%, which is above the forecast at 2.4. So overall, I would say that the inflation in the US still continue to remain very sticky. And when you contrast that with some of the other developed markets, we are seeing clear signs that, for example, in Canada, in Europe, in the UK, in Australia, some of these other developed markets, we are actually seeing signs that inflation is trending downwards and growth is slowing down markedly. So we do see that there is quite difference in that kind of trajectory. And so why is that the case? Why is there this difference? So let's take a look at the US, which is actually diverging from the rest of the world. So over here, this chart, let me take you through it. The black line, so you can see there's green and blue and there's black line on top. The black line shows you the total inflation number, right, in the US. So what is the inflation in the US? And you can see that inflation came down and spiked up very quickly post-COVID. And so that green portion shows you that inflation that is driven by supply. Blue is the inflation that's driven by demand. So very clearly you can see that the initial spike in inflation was caused by supply because of the COVID restrictions. We actually had a lot of supply constraints, and that was obviously made worse. You can see another spike, and that was made worse because of the Russian-Ukraine conflict. Right, so you can see that a lot of the inflation was caused by supply constraints. That has actually started to moderate because as the economies reopen, inflation, supply constraints, a lot of the supply chains open back up and supply constraints eased off. But you are starting to see that actually demand is contributing to a lot of that inflation in the US. So the demand in the US is continuing to be very strong. And that's mainly because the US is quite different from the rest of the developed markets in that they are less interest rate sensitive. So in response to high inflation, the Fed and all of the other central banks globally have been raising interest rates very aggressively to try and contain the inflation. But what happened is that in most markets, so let's say, for example, here in Singapore, if interest rates go up, what happens? The average household, the average consumer feels it because our mortgage rates, number one of the big major liabilities that we have, right? Or rather commitments that we have is to service our mortgage. So mortgage rates, I'm sure all of you are feeling it as well. High mortgage rates here. But in the US, that's very different because the US is the only market in the world that actually have a very different mortgage dynamic. They lock in their mortgage rates for 30 years. That's very interesting. Because what happens in the US is that when a homeowner goes and buys a house and takes a mortgage from the bank or whoever they take the mortgage from, they actually manage to lock in their mortgage rates and they pay that same mortgage rate for the next 30 years, 30. So that's why in the US, this is a much lesser interest rate sensitive economy. Most households, most consumers, they are not feeling 100% the effects of this high interest rate environment, which has again led to this strong demand and the continued resilience in the US. So we do think that in the US, inflation is going to be much tougher to bring it down. That last mile to bring it back down to that 2% inflation target, that's going to take much longer in the US as compared to other developed markets. And so our view at PIMCO right now is that because inflation continues to remain sticky, we are expecting that in the US, inflation will end at around 3 to 3.5% by the end of this year, which is again significantly still meaningfully above the inflation target of 2% that is being set by the Fed. And so our expectation is in terms of the number of rate cuts from the Fed. So to be fair, we don't think that the Fed is going to hike rates any longer. because economy is also starting to see signs of slowdown, and inflation is somewhat contained. It is no longer at the high levels that we saw in the past 2 weeks. But at the same time, we also think that because inflation continues to remain quite sticky in the US, we are expecting that right now for the Fed to probably cut only one time this year in December. That's PIMCO's view, and potentially even not at all. Okay, so either one at the end of the year or no cuts this year. So that's where PIMCO slightly differs from the market consensus, because if you look at this chart over here, you can see that we are right here now, here in the middle. Okay, so now we are in April, we are here in the middle, we are at peak rates. Again, nobody expecting any of the central banks globally to continue increasing interest rates. But the question now is, when will the rate cuts start to come? And so you can see that right now, this is actually what is being priced into the markets. What are the current pricing telling us? What are investors expecting? So you can see that right now, you can see markets are expecting a very synchronous path, meaning markets are expecting all of the central banks to move lockstep in the same direction at around the same pace. And so we think that given markets are right now expecting all of the central banks to cut rates, but our view, again, you can hear, is different. We think that the US is not actually going to cut rates that soon. So that's when we see that there could be potential for active management. There could be potential for discrepancy between what's being priced in right now and what's going to happen. And so we think that other central banks in developed markets could cut rates more than the US, which is why right now at PIMCO, we are actually finding more opportunities outside of the US. So within the next months and quarters to come, we will actually start to see much more attractive opportunities in other developed markets like Canada, like UK. We are expecting both the Bank of Canada and the Bank of England to start cutting rates maybe in June. Right? So that's where you can see that there could be more upside for bonds in these markets, because as rates come down, bond prices will go up. So, and less so in the US, where we are expecting rates to come down at a later stage. So, but why fixed income now? So why should we look at bonds now? As I've mentioned so we think that bonds actually provide value for a few key reasons. Number one is that bonds can provide diversification. And we think that right now bonds, that's a basic reason why you want to invest in bonds. Because if you look at how bonds have performed, there's a lot of numbers here. But basically, let me take you through it. So we've actually surveyed around 11 different periods in the past 5 to 6 decades where we've seen a contraction in the economy. Okay, so what happens when we see a recession? The returns of equities, stocks, is in this chart. And you can see that in most cases, when you see a recession, stock markets deliver negative returns. Pretty straightforward. The next one is bonds. How do bonds perform? And you can see in most cases, it is positive. Maybe in one instance it is negative, but usually bonds do well, because in a recession, when you see growth slow down, typically what happens? There's a flight to quality and safety. So bonds, being safer instruments, typically benefit in this kind of environment. So you can see when you do a comparison of the excess return, so how much do bonds outperform stocks in a recession? You can see the vast majority of times it is actually significant. On average, 13% outperformance of bonds versus stocks in a recessionary environment. We are not saying that right now economies globally are headed for recession. In fact, most economies are still able to avoid that recessionary scenario. But never say never. We never know. That's the beauty of markets, which is why, again, very important to have bonds in your portfolio to provide that diversification in the event that you do see a slowdown. At the same time, we also think that right now, on a standalone basis, when you look at bonds look very attractive, because when you think about whether should I buy stocks, should I buy bonds, don't just think about, it's a blind diversification. You also need to see what's the relative value. Do stocks look attractive now? Do bonds look attractive now? What kind of bond should I buy? So if you look at bonds right now, okay, press the wrong button. Okay, so over here we look at the valuations, right? We want to see prices move up and down. So, and we know that typically there's some sort of mean reversion. If the price is high right now, chances are, not that it can't go higher, but chances are you may see it come down. And conversely, if something is very cheap now, it can go cheaper, but chances are it may recover. So you want to buy when prices are generally on the lower side and sell when prices are generally on that higher side. And so we've compared the valuation. What is the current market pricing of different types of bonds? So we look just at bonds, different types of bonds, and we compare it to its price over the past 10 years. If the diamond is on the right-hand side, that means that it is cheap relative to the past 10 years. If the diamond is on the left, again, then it means that relative to the past 10 years, it's looking expensive. And you can see that across the different parts of the bond markets, most of them are actually on that right side. So most bonds are looking pretty attractive from a price standpoint. Of course, that doesn't mean that everything's cheap. You can see that over here, there are some bonds that look fairly expensive. And these would be your corporate bonds, investment grade, both investment grade and high yield. So right now, within fixed income, it's also very important to be selective. It doesn't mean that I say, hey, Pimple says that bonds look attractive. I'm just going to buy any bond I see out there in the market. Not everything looks attractive. In fact, right now, corporate bonds, those that typically you would buy on your own, we actually find those relatively expensive. And we are finding other parts of the bond markets, which I'll cover in just a moment, slightly more attractive at this point in time. And also, some of you may say, oh, but how about, is this the right time to be invested? Should I think about whether, bonds are bonds going to give you that kind of return? Because typically people think that bonds are very boring. Bonds don't give a lot of returns. I think very importantly, we need to understand that in bonds, how do you make the bulk of your returns is from coupons. The reason why a lot of people think that bonds are very boring is because we were in a very low interest rate environment for a very long period of time. Since 2008, we've actually been in, until very recently, we've been in a close to zero interest rate environment, which is why bonds don't give you much yield. And that's why people think bonds are boring. But because central banks have been increasing interest rates significantly over the past 2 years, bonds right now look attractive again, because if you look at this blue line actually shows you the yield of bonds. And you can see, as I've mentioned, bonds have been in this really low yielding environment for 15 years, more than 15 years. And now we are actually starting to come back up. And this green line, you may be wondering, what is this green line? This green line is actually your 5-year forward returns. So what this means is that, for example, if you had invested in the bond markets at, say, this point in time, right, when interest rates were at about 7%, and then you invested and stay invested for 5 years, what is your annualized return? It's also around 7%. And in fact, this starting yield, that level of yield in the bond markets at the point you invest versus your returns over the next 5 years, there is a 94% correlation, which means that the current level of yields you're getting is a very good indication of what is the kind of returns you're going to get in the next 5 years from bond markets. And currently, yields are giving you the highest levels that we've seen in the past 15 years. So that also gives you an indication that right now is a pretty good time to invest in bonds, because bonds can give you higher returns. I'll back it up one slide. If you look over here, just high quality government guaranteed kind of bonds is giving you around 5%. If you look at the US right now, US Treasury is giving you around 5%. So that's kind of telling you that over the next 5 years, just by investing in even government guaranteed securities alone, you're getting around 5% returns per annum. Pretty decent if you ask me. And how about cash? Cash also gives you very good yields right now. So some of you may say, oh, but cash rates are very attractive right now. Cash has no risk. If I buy bonds, yes, you can see that bonds look attractive, but there is still some sort of risk that I might lose my capital. Well, that's true. Bonds, there is some sort of capital risk, but at the same time, we think that a lot of investors don't fully appreciate that cash has something called reinvestment risk. So it's a hidden risk because right now, cash is giving you high levels. But once the central bank start cutting, your cash rates will come down very quickly. Say you get into a fixed deposit right now, lock it in for 3-6 months. Chances are when your fixed deposit matures or expires, you are not able to grow it into another fixed deposit at the same rate. Cash rates will come down very quickly the moment central bank starts cutting rates. So that is the reinvestment risk that we are seeing. And at the same time, if you put $100 in cash, it will always stay $100. There's no upside except for that fixed deposit rate or cash rate that you're getting. In bond markets, if rates start coming down, bond prices will go up. So there's an additional potential capital upside that you're getting in bond markets that you can't capture if you stay in cash. So over here, we've actually done some studies to see that, right now we're at this point where rates are peaking. Before the peak, as rates continue to move up, obviously cash outperforms because as rates go up, bond prices fall. So cash, which is shown in gray, outperforms your bonds. But what happens when we are starting to see rates move in the other direction? As rates come down, you can see that cash actually underperforms bonds, be it on a 1-year basis, 3-year basis. So I think it's quite clear for investors that it is time to start moving into fixed income if you haven't done so. So that leads me to the second section, which is the PIMCO Income Fund. So the PIMCO Income Fund is PIMCO's flagship income fund, or rather our flagship strategy. What we do within the PIMCO Income Fund is that we try to deliver a very consistent level of income to our investors. So as you can guess from the name of the fund. And at the same time, we are also balancing. You can see that there's this scale over here. When we are trying to deliver on that consistent income, we don't want to just go all out and buy high yielding bonds and to deliver that income. We want to actually have a very a mindful approach to balance the yield objective versus the need for investors to preserve capital. So downside protection is a very important element of our strategy as well, which is why we are always thinking about balancing that need for quality versus that need for yield. So if you look at the PIMCO Income Fund right now, the yield of the fund currently is at 6.8%, very attractive, out of which we pay out 6.3% to our investors. We keep a bit of buffer. But that goes back into the NAV. We are not being shortchanged, even though the yield of a portfolio is higher than what we're paying. And at the same time, we are achieving this level of yield with a very high quality in the fund. The fund has an average credit rating of AA-. So we are, again, balancing that need for quality with that level of income. So and the fund has been around since 2012. So this year is the dragon year. The PIMCO Income Fund is also a dragon baby, right? So we have had a very long track record in delivering that consistent level of returns for our investors. I'll show you that slide on performance later, and you can see what I mean. I mentioned just now that the PIMCO Income Fund is targeting a stable distribution. So exactly how much are we giving out? And you can see that I mentioned just now, we are paying 6.3 currently. And actually, that's only in the recent environment. You can see that since the launch of the fund, we've actually had a very long track record in paying around 4%. So we were paying around 4% for many, many years until recently in the past 2 years where we increased the distribution to 6.3% currently. And that's because, again, going back to what I said earlier, we were in almost a close to zero yielding environment for more than a decade. So in that kind of environment, when cash was giving you close to zero, we were actually giving 4%. And as rates go up, we also adjust upwards. Now, some of you may ask, so how about going forward? If interest rate starts coming down, what happens, right? So we are very mindful about making sure that we don't pay out of capital. We are not going to take your money and pay it back to you. Okay, we want to ensure that we generate sufficient income in the fund in order to sustain the distributions We've never paid out of capital before, and we would not do so going forward as well. So if, let's say, at some point in the future, if rates do come down, interest rates come down to a level where this current 6.3% is not sustainable, we would adjust the level of distribution then to pay from your capital, right? But at current juncture, we are quite comfortable to maintain this level of distribution probably for the next 12 to 18 months. We would have to continuously monitor the level of rates in the market to see what is the appropriate level that we can pay out to our investors. Another thing about the PIMCO Income Fund, why have we been able to deliver very consistent performance over time is because of our flexibility to really look for the best income generating ideas across the entire global fixed income markets. So this is a global fixed income fund. We can source for the best ideas anywhere globally. And you can see over here, I don't want to go into too much details here, but each color of this chart over here represents one sector of the global bond market. And you can see that it is not static. So we don't just say that, hey, we're just going to diversify the portfolio and be done with it. We would continuously look for where are the best ideas across the different sectors of the bond markets and shift the portfolio accordingly to really continue to deliver on that dual objective of income and downside protection for our investors. So with that, what is our current view of the market today? Where are we finding the best opportunities? How have we been moving the portfolio recently? So you can see over here 3 pie charts. This one is as of end of 2021. So that's about 2 years ago. And then fast forward to end of 2022 and then current position. So the way that we think about the bond markets, okay, there's a color coding here. When we think about high quality bonds that can provide downside protection, these would be shown in the blue and the green portions. And then the higher yielding bonds that would actually generate that higher level of income would be in the reds and the pinks. Right? And you can see that we were previously quite equal. We are trying to balance it, but we can see that we've been gradually shifting more and more to the blue and the green portions of the portfolio, going up and up in quality. Main reason is because yields have just gone up so much, right? Market yields have gone so much that right now we find ourselves in a very good position that you don't actually need to take a lot of risk in order to generate a very decent level of income. So even by having 3/4 of the portfolio in very high quality assets, we are able to generate a very attractive level of yield at 6%. So you can see that we've been shifting the portfolio. And right now you will see that the largest portion of the portfolio is in this light blue portion, which is called agency MBS. So I just want to touch on that before I go into performance. Some of you may ask me, what is this agency MBS? There's a lot of acronyms. So I want to know what's in it. Agency MBS. MBS stands for mortgage-backed security. So what is a mortgage-backed security? Let me take you through it. Very simple. All of you understand the concept of buying a house, right? So when you buy a house, most of us don't have enough cash to pay the entire, to pay up front. So we will take a mortgage from a bank. We go to a bank, we take a mortgage. So what happens is that this bank lends money to the homeowners, and every month you have to service a mortgage. So every month the homeowners pays down their loan together with interest to the bank. Now the bank don't only lend to one person. The bank lends to a lot of homeowners. So a lot of times the bank don't want to hold everything on their portfolio. They want to offload some of that risk. So they will actually sell some of these mortgages to a third party. And these third party, they aggregate all these mortgages together. And then based on this, because what happens is that every month when homeowners pay their mortgage, they pay cash to the bank. The bank then passes on these cash flows to the aggregators. And so these aggregators will then issue a bond. They will sell bond out in the market, which is called the MBS, the mortgage-backed securities, to investors like PIMCO that buy these bonds. And when these cash flows through, these aggregators will also continue to pass on that cash to us. So this is a mortgage-backed security, meaning that the cash flows that we are getting when we buy a mortgage-backed security is actually backed by a very, very diversified of home loans. right? Very, very diversified pool of home loans, typically thousands of home loans that will flow through to us. Now, you may ask, is this very risky? Number one, because it's very, very diversified. So again, that level of diversification already brings down that level of risk, because what are the chances that if, let's say, your cash flow is backed by, let's say, 1,000 homes, that all 1,000 homeowners will default at the same time? Pretty low, right? So diversification is already one of the key reasons why you would want to invest in a securitized asset. Secondly, I mentioned just now that our favorite sector right now is agency MBS. So agency MBS is, keep pressing the wrong button. All right, is in the agency, is on the left-hand side here. What happens is that you see over here, I described the structure of a mortgage, a backed security, and is actually made by thousands and thousands of home loans. So if there are any homeowners that say that, oh, I lost my job, I can't pay my mortgage, I default on my mortgage, you come and take my house, right? So what happens is that these losses will actually accumulate from the bottom. So if you're invested in some of the more, what we call junior tranches of a mortgage-backed security, you will absorb losses first. If you invest in a senior part of the mortgage structure, so typically mortgage-backed security can be sold in different tranches. If you invest in a senior tranche, you will be more protected. So you will take principal repayments first and losses last. Interestingly, what we invest in, the light blue portion that I mentioned, is the agency MBS, where you can see that there's no red. And that's because this is 100% government guaranteed. So these are issued by your government entities in the US, our government agencies in the US, Fannie Mae, Freddie Mac, and Ginnie Mae. You may have heard of these before. And they actually guarantee all of the mortgages, meaning that if any loan within that pool defaults, these agencies will absorb the losses onto their own books, and they will continue to make sure that they pay the coupons and principal to us as investors. So these are actually government guaranteed assets, which is very, very high quality. And at the same time, when we look at the valuations, I mentioned just now, valuations is very important. We want to invest in assets that look cheap. And so this blue line shows you the valuation of this sector. And the higher it is, the cheaper it is. You can see that it has cheapened significantly over the last 2 years. And that's because the Fed was actually implementing quantitative tightening. So there was lesser demand from the Fed, which actually led to these assets cheapening up. We like them, and as they go cheaper and cheaper, we buy more and more on the downside, right? So as the prices go down, we scoop up more of them, and we are starting to see recovery because the Fed we think that coming to the end of their quantitative tightening program. So we've already seen some recovery in this sector. So that's one of the main reasons why we favor agency mortgage-backed securities in our portfolio as our largest holding at this point in time. But again, I want to stress that this portfolio is highly active. Just because we love agency MBS now doesn't mean that we will always have this much agency mortgage-backed securities in the portfolio. We will adjust accordingly depending on the opportunities in the market. So I will round it off with talk about the performance of the fund. Again, I can go on and on, right? But the proof is in the pudding. So you need to see how the fund has done. And you can see that over time, since inception, for the last 12 years, the annualized return is around 5%. Pretty good, because when you're considering what cash was giving you in the last 10 years and what the reference benchmark, which is a high quality index, was giving you about slightly over 1%. So you can see that we've actually been able to deliver much higher returns than what you're getting in the generic bond market. And I would say that if you look at the performance of the fund on a year-on-year basis, it's a little bit busy here, but focus on the blue bar. Okay, the blue bar is the performance. Green is just assuming you have to pay a 5% sales charge, which I understand Philips does not charge. That's right. May not charge. Okay, so just focus on the blue line. Okay, and so you can see that on a year-on-year basis, there was only 1 year where the Pimco Income Fund actually had a negative return. And that was in 2022. And we all recall 2022 was the year where inflation was out of control. Bonds actually had their worst performing year in more than 4 decades. So, and even in that year versus the broader market, which is the red bar, you can see that we actually outperformed the broader fixed income market by around 5%. So we had much lesser downside, even in a very difficult environment for bonds. And is this the right time to invest? We think so, because if you look at this chart over here, this shows you the yield of the fund since inception. Recall just now I mentioned there's a 94% correlation between your starting yield and your expected forward return. So you can see that over here we've shaded 4 bars. If you had invested in the fund at these periods where the yield of the fund actually spiked and peaked, the returns 1, 3, 5 years after that actually were meaningfully higher than that long run track record I mentioned. So again, since inception, annualized return around 5%. If you are invested in these periods where yield was higher than usual, the returns was actually above 5% on average. And in fact, 1 year return was closer to 10%. So right now, the yield of the fund at 6.8, not at its highest, but pretty much very high relative to history. So we also think that right now is a very good time to be entering into bond markets and entering into the portfolio fund. So let me sum it up again. I will recap the points again today. If you've forgotten whatever I said earlier, I just want to provide a quick recap. Again, number 1, there is very, very compelling value in bond markets today. Because again, we are at the highest yields in many years. Currently, with the fund yielding at 6.8%, we are paying out 6.3% to our investors on a forward-looking basis. And the Pinpoint Income Fund has had a very long track record, 12 years in managing funds for our investors. We've only ever had 1 down year in this last 12 years. So this is a testimony of our expertise in being able to deliver returns for investors. And across our peers, we are actually the top fund within our category over this 12 years as well. So with that, I will hand it back to Philip and the next speaker.
Thank you, Alice. Okay, I'm sure you all have burning questions for Alice, but we'll leave the Q&A to the very end. Those of you, the question cannot wait one, you can scan the QR code in the live audience. You can pen down your questions, then we'll compile later. So those at home, you can type in the chat. Okay, so hand on to the next speaker, Leonard from Fidelity. Okay.
Okay, testing. So first of all, thanks very much everyone for sharing your Saturday morning with me. And I think I'm the middle child for today's panel. There are 3 people and people always say that they forget the middle child. And another thing that people mention about presentations is that they usually only remember the first 3 things that you talked about. So I'm not going to waste the first 3 things that I'm going to mention today. And these are really the 3 things that I hope to leave you with from today's session. The first is going to be the fact that we think now is a very attractive time for you to look at bonds simply because yields and interest rates are higher. The second point is that we have seen the stock market doing very, very well. It looks like the overall economy is very optimistic. It pays very well for you to start looking at the more defensive parts of the market, look at bonds as a way for you to patch out some of this market risk because everything looks like it's pretty much priced to perfection. And of course, last but not least, don't forget my name. So I'm Leonard from Fidelity, and I'm very happy to be the second speaker for you guys today. So maybe let me just take a quick introduction to explain to you who Fidelity is and what it is that we do. So we say the first thing in terms of our heritage as an active asset manager, we are not a new kid in the block. We have had over 50 years of heritage in running investments for clients. And another point that I would like to share also is that we are a privately held company. So we don't answer to public shareholders. There's not so much of a short-term earnings pressure. We are hyper-focused really on answering to our end investors in making sure that we manage your investments to deliver returns for the longer term. Second point, in terms of assets under management, today sits at over 770 billion US dollars, and much of it is going to be within actively managed funds. So that is really our heritage. We do active management of portfolios. We are seldom in the ETF space, in the passive space. We are really focused on the traditional parts of the market, making sure that we are actively watching portfolios to react and respond to market conditions. Last but not least, Fidelity is known for research. We are known for our wide and extensive network of research analysts across both equities and also bonds. And it's quite interesting because even though we are talking about a bond fund today, we are actually tapping on our equity research platform, our equity analysts, to also guide us on whether or not the companies whose bonds we are investing in, are they going to be strong fundamentally? Do we have a good view of the business model? So that's really Fidelity in a nutshell. Hyper focus on investments, making sure that we are watching over our clients' portfolios actively, and last but not least, backed by the wider network of research analysts. So recently we came off Oscar seasons for the movies, and we also came off Oscar seasons for the asset management industry. So this is really the bunch of accolades, industry recognition that we have been able to achieve right here in the asset management industry. We have gotten nominations for running best equity funds, best fixed income funds, and of course, overall fund house of the years for a number of all these award providers. So maybe let me just take you through a quick market backdrop and to share with you some of the views that Fidelity has in terms of where we think the broader economy is headed towards, and more specifically in the bond market, how things are looking like. So I would say the top question that we typically get is about whether or not we see a potential recession play out in the market. If we think back to 2023 and we saw some of the news headlines, people were wondering whether or not there was going to be a recession coming about in the US, global economies. And what we have seen is that headline news have changed a little bit this year. In fact, right now, the market does not think we are headed towards a recession. Overall, what the market is pricing right now is sort of a no landing scenario, which simply means growth looks like it's relatively strong. It looks like we are able to keep up with some of these inflation fears, even though things look a little bit sticky in the last mile. But overall, no one is expecting the global economy to be headed towards a recession. And that is also the reason why we have continued to see the stock markets going up. We continue to see how the broader economic data has been quite strong. Here at Fidelity, we do hold a little bit more of a cautious view. We do think we may see a soft landing play out rather than a no landing that the market expects. Soft landing just means we may see growth slow a little bit, but we do expect to see central banks cut rates earlier than expected, earlier than what the market is pricing in today, to try to guide the economy back on a path of recovery. So that is Fidelity's view. We do think that things look a little bit too optimistic right now based on what the market is pricing. And this is where we think the growth risk is actually tilted a little bit more to the downside. It pays to be a little bit more defensive, start looking at adding bonds into your portfolio to build some resilience for your portfolios. So in terms of inflation, Alice did quite a bit of heavy lifting just now to share about how inflation has been trending. For our views, we do think that inflation has trended down quite meaningfully. Right now, we are at the last mile, which is really what the market is waiting for, to see whether or not things will naturally hit towards that magical 2% that we always hear about in terms of what the Fed is targeting in inflation. Right now, the market is fearing a little bit that inflation may be sticky, inflation may stay higher for longer. But our views here at Fidelity is that we do think inflation will trend down meaningfully, and we think that it will eventually get back to that target range, simply because we think global growth is going to show some signs of a slowdown for the rest of the year. In terms of interest rate cuts, we have seen over the last 1 week, markets have very aggressively priced out when they think the first cuts will happen. Back in Q4 last year, they were quite aggressive in thinking that as early as March, we will see the first rate cuts. And of course, as of last week's news, we have seen how expectations have pushed out rate cuts all the way to the end of 2024, with some even saying we may not see as much of rate cuts happening. Here at Fidelity, we do think rate cuts may happen faster than what the market thinks, simply because if you take a look at the broader economy, a very big part of the economy in the US is being driven by consumers. So the person, the man on the street that's going out there to spend at the retail stores, this actually accounts for almost 65% to 70% of the US economy. And if we take a look at the health of the consumer sector, what we have seen is that previously during the COVID pandemic, a lot of people were saving up on money because they were not going out there to spend. So households actually built up quite a lot of savings. They have been able to keep up with higher inflation, with higher interest rates of the last 2 years, simply because they have been drawing down on all these savings that they have built up over the pandemic. So right now, if you take a look at the chart on the left, what we can see is that excess savings have actually been drawn down from all these households trying to keep up with higher cost of living, with higher interest rates. On the right-hand side also is something quite interesting. In the US, we do notice that there are quite a lot of people who are starting to take on more than one job. I think this is something interesting in the US because in Singapore, I would love to take a second job to try to get a second income. But I think our working hours are quite long already in Singapore, so I don't have time to take a second job. But in the US, we have already seen this trend picking up. We are starting to see more people taking on a second job. And this is something that's quite worrying to us because we have seen how household savings have come down and we start to see more people taking on a second job just to keep up with higher cost of living. More importantly also, you have been reading the news, we have been seeing companies talk about focusing on cost cutting. And this hasn't just been happening with some of the largest banks which are known for focusing on cost. Tech sector have also started to see some layoffs, some restructuring. So job openings, we are starting to see real-time data trend downwards. So even though you're reading in the news that unemployment in the US is at historical lows, if we take a look at the forward-looking data, if we take a look at what's happening right now in the news, it looks like the job market is starting to show some signs of cracks. On the right-hand side also, if we take a look at the smaller businesses, usually the smaller businesses that are not so strong, not as large as some of the larger businesses out there, these are actually a very good indicator of how things are looking in the economy because smaller businesses tend to be a little bit more vulnerable. What we see with smaller businesses is that they have already started to feel the pinch, and we see this as a leading indicator for potential weakness for larger companies out there. So another thing that we usually look at are surveys, simply because these are more reflective of what's happening now than to just wait for a month later to see how the economy has moved. So if we take a look at some of the job reports, some of the job surveys, what we're seeing is that people have given some indication that they feel like there's a higher probability that they may not hold on to their jobs. So overall job sentiment is a little bit weaker than where it was previously. On the right-hand side also, it's starting to show that income, particularly the lower income segment, this is where they start to feel that their jobs are a little bit more at risk. So I would say that what I've been really trying to share is the fact that when we take a look at the US economy, when we take a look at where the stock market is, and when we see where sentiment is at, everything looks to be priced to perfection. Everything looks to be very optimistic, and this is all reflected in the price. But if we take a look at some of the real-time data, if we take a look at some of the expectations of where we see the US consumer sector heading towards, which is a very big part of the broader economy, we think the risks are tilted towards the downside. And this is also why we are talking about high-quality bonds today. So if we take a look at the chart on the left, this is going to compare the yield that you are getting from bonds compared to stocks. So for all of you who are investing for the purpose of income, what you have been able to rely on traditionally has been coupons from bonds and also stocks from dividends from stocks. And if we compare the yield that you are getting from bonds today to the dividends that you are getting from stocks, what you can see is that the yield that you are getting today from bonds is very, very attractive. So this is one of the reasons why we say look towards anchoring your portfolios in the safer parts of the market, because this is giving you very high quality yields without exposing yourself to as much downside risk as if you were going to rely on equities, on dividend stocks for that source of income. On the right-hand side, also, it's just going to show you that today, what you're being compensated for taking on equity risk, for going out there into the stock market to take some risk, compared to bonds, it does not look as attractive. You're not being compensated as much compared to history. Okay, so if I take a look at this slide over here, this is going to show you how bonds have been able to perform every single time the economy has shown some signs of a slowdown. So what we have done, we took a look back all the way to 1950 to 2023, so almost 53 years worth of data. And what we have done is we have compared how bonds have performed versus the stock market during such periods of a slowdown, which are basically the gray bars over here. And what you can see is that, like Alice mentioned previously, every time you enter a recession, every time you enter a sort of global growth slowdown, the riskier parts of the market will sell off. And this is where you see equities, the stock market, you can sell off anywhere between 10%, 35%. But if you take a look at how bonds have performed during these periods of time, when the market is panicking and when people are selling out stocks, bonds have been able to perform very, very well. They have been able to deliver positive returns when the rest of the stock market is in the red. So this is one of the reasons why we say that today, if the stock market looks like an all-time high to you, you are being a little bit more cautious about where things are headed towards. Adding bonds to your portfolio gives you the higher income that you can get from higher interest rates today. More importantly, also, it can help you hedge out some of this potential downside risks if markets are to slow down. Okay, so I would say in terms of how you want to express this view, in terms of how you want to get exposure to the safest parts of the bond market. If you think about the bond market, the safest parts have always been what we call the US government bonds, US treasuries. These are always known as the safest part of the bond market. And then, of course, on the other side of the spectrum, you have your higher yielding bonds. So for Fidelity US Dollar Bond Fund, what we are really focused on is the safest parts of the bond market. We look at US government bonds and also US investment grade bonds as the two major building blocks within the portfolio. So high yield bonds within the portfolio traditionally has not exceeded more than 10% of the portfolio. Today, because we are being a bit more cautious about the broader economy, high yield bond allocation within the portfolio is extremely low. It's at around 2% today of the overall portfolio. So the two major parts of the portfolio today is going to be anchored in US government bonds and US investment grade bonds. More importantly, also, I would say in terms of the track record that we are bringing to the table, this is not a new fund on the block. We have been running this since 2009, and I would say that our current portfolio manager has been on this strategy since 2009. We launched it in 1999, in fact. And since 2009, when our portfolio manager has been running this strategy, we have had zero defaults occur within the portfolio. And this is really reflective of how we are anchoring the portfolio within the safest parts of the market, focusing on those as the two major building blocks. Last but not least, we want to make sure that we are dynamic. We want to make sure we are actively responding to changes in the market environment. So even though we are going to be playing within the safest parts of the bond market in government bonds and investment grade bonds, we are not just simply buying them and holding them. We can actively manage and rotate depending on whether we want to add risk or whether we want to take down risk. So just to give you an example, if we think right now is a good time for us to add risk within the portfolio, what we will do, we will rotate from government bonds into investment grade bonds that are issued by companies, just to bring a little bit more risk within the portfolio, give you a bit more upside participation. And when we want to take down risk, when we want to be more defensive, this is where we will rotate from investment grade bonds issued by companies, add a little bit more towards government bonds. So this is something that we do very, very actively, even though we are playing within the very, very safe parts. We actively rotate between these two major building blocks just to control the risk that we want to expose investors to. So we also like to take the chance just to lend a face to the strategy, that you see who are the portfolio managers that are backing up this strategy. So Rick is the main portfolio manager within this strategy. He has been running this, like I mentioned, since 2009. So he has seen through multiple market events, market crises, navigated through some of the most challenging times in the bond market. He is backed up by two other core portfolio managers, Ariel and also Dan. And last but not least, I would like to say that they are always backed by Fidelity's wider research network, not just the credit research team who looks at bonds. We are also backing them up with our equity research team who are engaging with all these companies on a very regular basis, just to give us some more insight, just to give us a bit more conviction in the bonds that we want to choose to own within the portfolio. So I would say in terms of asset allocation, the chart on the left is going to show you how we have adjusted our allocations across different market cycles. So what you can see, the part in blue is going to represent the fund's allocation to US government bonds. The part in yellow, that's going to represent our allocation to investment grade bonds issued by companies. And what you can see is that, first of all, these two are the major parts of the portfolio. And another thing that you can see is that it is moving up and down quite actively, which also means we are rotating very actively between these two building blocks to respond to changes in the market environment. On the right-hand side, what you're going to see, credit rating. So if you think about bonds, BBB is basically the cutoff for when a bond is considered an investment grade bond. So everything on top of BBB, this is basically what we call investment grade bonds, the safer parts of the market. Our credit rating has always been anchored within the higher quality parts of the market. So traditionally, always between single A to double A. We are never going to be hugging the line at the BBB range. And I would say, if I reflect a case study to show you how we have been able to navigate very challenging market conditions with Fidelity US Dollar Bond Fund. Take a look at COVID period, because that was really a year when life was really flipped upside down with the outbreak of the pandemic. Over the COVID period, we saw a year of two halves. The first half was when we had the pandemic come out, and then there was a severe risk-off kind of a scenario. There was a lot of panic selling happening in the market. Within the first half, what did we do when the market was panic selling? When we saw this sort of risk-off happen, what we tend to see is that government bonds, which are the safest parts of the market, they tend to appreciate price because of the flight to quality. And because of that, we held quite a bit of government bonds. We were sitting on quite good profit. When market was panic selling, we rotated from government bonds into investment grade bonds issued by very, very strong companies that were simply selling off because of panic, because of sentiment. So we took advantage of that to buy some of these very good quality bonds at very good discount. And in the second half of COVID, when the market recovered, what we did was to then take profit from these investment grade bonds and rotate into government bonds just to build a bit more defensiveness within the portfolio when everything was starting to look more expensive. So something that we do very, very actively, make sure we are responding to market changes out there. So in terms of performance, I would say this is reflected in the chart. Thankfully, it does speak for itself. So our fund's performance is the one reflected in the blue line. And our index performance, basically the benchmark that we compare ourselves against, we have been able to outperform the benchmark in the orange line over here by quite a significant margin. And I would say some classic case studies to also share again on this slide. If we think back to the COVID period, when we saw a risk-off happen, when we saw panic selling happen, how did the fund perform? We were up around 12% relative to the index that was up around 8 plus to 9%. If we take a look more recently in the year of 2023, despite the sort of volatility that we saw in the interest rates market, because we were able to flexibly navigate the changes in the interest rate environment, we were also able to deliver a very decent return of around 6% right now. So broader kind of a track record, seen through different market events, being able to defend the outperformance against our index, and at the same time also being a very useful allocation to try to hedge out some of the market downside during challenging conditions like 2020, when we saw a lot of panic selling happening in the market. This is going to be a very useful kind of a case study for why Fidelity US Dollar Bond Fund can be the allocation to build resilience within your portfolio. So in terms of some of the key portfolio characteristics, so there are a lot of bond funds out there. One of the key kind of metric that we look at is duration. So duration is nothing more than a number that will show you how sensitive the bond price is to changes in interest rates. So it just means that if you have a higher duration number, we expect the bond price to change more than a sort of portfolio with a shorter duration number. So if you think back to where we are today in the interest rate cycle, right now we do think that we are at peak rates. From here onwards, it's just going to be a question of when the rate cuts will happen and by how much. And so that's really why you want to be positioning your portfolio also with some bonds that have longer duration, with some funds that have a bit of a longer duration profile. Because when interest rate cuts start to materialize, when you see bond yields start to fall, portfolios with a higher duration number will be able to see a greater capital appreciation potential compared to portfolios with a shorter duration number. So today, the duration of the portfolio is at around 6.9 to 7 years. So this is also one of the reasons why we say that if we do see interest rate cuts happening faster and greater than expected, we do expect the price of the portfolio to appreciate to a greater extent than some of the other funds with a shorter duration number. So in terms of how we are currently positioned, so on the left-hand side, this shows you our asset allocation, how much we're allocated across the different kind of sub-asset classes within the bond market. What you can see is that our exposure to US government bonds, so the safest parts of the bond market, right now is the main part of the portfolio at around 52%. We have around 40% allocated towards investment grade bonds issued by companies, half of which are going to be anchored within bonds issued by very systematically important banks. So for example, some of the national champions out of the US and even some of the European banks that are issuing US dollar bonds, these are going to account for a very big part of the portfolio. I mentioned today we are going to be more defensive, and that is why you see high yield bonds within the portfolio is very, very low at around 2%. So in terms of payout wise, we do have two different share class options available on Philip's platform. We do have a money income payout share class known as the M income share class that pays out around 4.5% per annum. And we do also offer a higher payout share class that gives out 6% for clients who just want to maximize your money payout. So in terms of the overall portfolio characteristics, in terms of assets under management, today it sits at above $3 billion US dollars. And I would say in terms of our underlying yield to maturity right now, we are seeing it at around 4.6%. And in terms of our overall exposures, we are always going to be anchored within the safer parts of the bond market, in government bonds, investment grade bonds. High yield bonds are low today. We have never exceeded 10% within the portfolio. Today is at about 2%. And this is also why we say that if you're looking for a high quality bond fund, just to hedge out some of the risk and also lock in some of the higher yields that you can get within the safest parts of the market, you can look at Fidelity US dollar bond for an allocation to try to build some of this resilience within your portfolio. So maybe before I wrap up, I just wanted to also take the chance to do a social experiment with the audience over here. So maybe the first experiment I will ask, there are two options for you to choose from. The first option is for you to walk away with $1,000 guaranteed. So that's option A. Option B is going to be a 90% chance to walk away with $1,200, but a 10% chance that you may lose $300. So the question is, for this scenario, which one will you choose? Option A or option B? Option A, show of hands. And option B? Well, we have a pretty balanced crowd. Don't worry, I have another one. So now for the second experiment, okay? The question is, option A, would you walk away and cut loss and guarantee a loss of $1,000? Or would you go with option B, a 10% chance to walk away with $300, but a 90% chance that you will lose more than $1,000? Option A, show of hands, cut loss at $1,000. And option B, 10% chance of walking away with more. Okay, so we have a pretty interesting crowd. Usually when I run this experiment, it's always a different kind of response. But usually what we tend to see for the first scenario, people tend to choose the option which gives you a guaranteed $1,000 rather than to take the chance for a 90% chance, a higher chance of walking away with more, but just a 10% chance of walking away with a loss. For the second option, when it comes to cutting losses, what we see is people tend to gamble. Rather than to cut loss at $1,000, they would rather take a 10% chance to walk away with something more. And this is the kind of behavior that we are seeing today in the market. We are seeing a lot of investors just focusing on putting their monies in fixed deposits, government T-bills, because these are guaranteed, these are looking quite risk-free. And this is despite the fact that if you are looking at bonds today, the odds are actually in your favor. Like what Alice mentioned just now, and we also have a slide over here, but maybe it wasn't shown. But right now, the kind of entry point that you have when you are buying into bonds today, when you are looking at government bonds giving you 4.6 to 5%, these are yields that you have never seen before in decades. So you're getting this from anchoring yourself in the safest parts of the market. And also, if you think about interest rates right now, we don't expect to see interest rates go higher from here. In fact, it's going to be a question of rate cuts hereforth. It's going to be a question of when it happens and by how much. And we all know that when interest rates fall, we do see bond price appreciate. So today, the odds are very much in your favor. The odds are very much in your favor for you to go out there to anchor your portfolios in bonds for higher yields, hedge out some risk, and also position your portfolios for falling rates for that boost on capital appreciation. So with that, thank you very much for listening to the session, and do send in your questions also. I hope that we'll be able to address them at the end of this session. So with that, thanks very much, everyone.
Okay, thank you very much, Leonard. So as mentioned, we have allocated time at the end of the session for Q&A. So do compile your questions. We'll answer it later on. Let me see this slide here. Okay. So last but not least, we have our final speaker, Sabrina from Manulife. So she's going to touch on what has not been covered yet. Asia. Asia fixed income. So one applause for Sabrina.
Thanks, Nick. All right. Hi, everyone. Good morning. Thanks for spending your Saturday morning with us and learning more about fixed income. So I'm Sabrina. I'm from Manulife Investments. So I think there's a lot, my fellow PIMCO and Fidelity, friends have actually covered. So my job is not easy, basically trying to share more than what they've actually shared, and being the last speaker as well, before, you get on with your Saturday. So like what, really quite obviously right now, rates are definitely going to be coming down. It's just a question of when. And honestly speaking, I mean, after hearing, talking from the two speakers before I get into mine, I think you don't want to wait until the Fed cuts the rates and then you get in. That's probably too late. You probably want to start positioning your portfolio early, at least to ride when that, transition happens there. So before I get into that, let me just share a little bit on who I am. So I think for Manulife, you are probably very familiar with the insurance brand, but how many of you have heard of Manulife Investments? You know, a quarter of the room, huh? Okay. Yeah. So Manulife Group, okay, it's a very big group. I'm sure you're very familiar with the insurance, my insurance parents. So you probably have policies with Manulife Insurance there. So Manulife Group has the insurance entity, which is the largest product provider, but there's also the asset management arm. And the asset management arm manages about close to 750 billion in assets. We are very well placed out globally. The main hubs are in Hong Kong, within Asia, in Canada, of course, where home country is, in London, as well as in Boston. So as you can see, this is the global footprint. Even in the Singapore office, we do have our Asian fixed income team that sits there along with our Indian equity and needs team. This is a little bit on where we are, placed in terms of the strategies that we are known for. So fixed income is very big for us because, as you know, for our parentage, we are part of the insurance. So we started out obviously managing the par funds for insurance, for the insurance monies. And that's actually the largest slice in terms of the business that we have. Other than that, of course, we do have equities, multi-assets. So we run a multi-asset fund. You probably have the material in your pack. It's a fund that's quite well diversified between equities and bonds. You can have a look. And then, of course, in private markets. Now, getting on with the macro perspective first. So this is actually the report card for 2023. So this was last year. I don't know how many of you felt last year was very more negative than positive. I felt actually last year was a little bit more negative with a lot of the news going on, geopolitical problems, China's inflation, China's structural issues, the US inflation, also the uncertainties of US hiking rates and when are they going to stop. But interestingly, the market, if you see for 2023, ended pretty nicely, positively. If you see everything is all on the right. The only one that's negative, of course, quite expected is China. So contrary to how we felt in 2023, it didn't do too bad actually. So if you look at 2024, and that's for quarter one, again, nice, decent performance there. If you see, most of the countries, the sectors are doing pretty well. The only one that you see again negative is China. No surprise there, and a little bit on the bonds aspect. But you can see that for Asian credit, Asian bonds, it does possess a bit of resilience there. And what I don't have here, because I just pulled it out of Bloomberg, basically, last week, markets have been a little bit choppy. And that's on the back of, Jerome Powell announcing that rates could be higher for longer. And, for the month of April, at least, given what the drawback has been last week, the markets actually did underperform. So if you see equity markets, it was down between 4 to 5% just last week. Bond markets were down between 1 to 3%. And Asian investment grade bonds actually, dropped lesser than the rest of the other asset classes. In fact, dropped about, 1.2. So we know that, rate cuts definitely is going to benefit bonds. And, the thing is, the whole premise about what's been going on, if you see, I jump to this slide, is this. The inflation numbers for US actually is starting to creep up a bit. So this is 3.6 as of March. So, there's been periods of time where it's come down, markets are hopeful. And we went through quite a number of months where, it's not kind of reaching that 2% target, but we kind of know that, US probably will not hit that 2% target anymore for inflation, but it's starting to trend up, which is why Powell then say, okay, maybe rates are not going to get cut so soon, which what markets actually thought it was. For Manulife's view, we probably think it's going to be 1 or 2 rate cuts at max. But you see, this is the situation for the US right now. For Asia, it's actually a very different picture altogether. Asia, right, the inflation is actually low. So you read a lot of, information there that for like Indonesia, Thailand, Philippines, benign inflation is actually there. So their policy rates are high, and basically that gives these Asian governments a lot more room to actually cut the rates. In fact, it's kind of foreseen that Asia could actually cut the rates before even US does. And actually that would have benefit for Asia bonds in a nutshell. Let's skip this one. So looking back on history as well, okay, if we look at the last rate cut cycle, and that's basically in July 2019 and March 2020. So this is actually the period that markets saw the last rate cut cycle. And if we see this period, right, that was when the Fed actually cut from 2.5 to 0.25. And interestingly, right, during this period of time, so that exact period I extracted out, this is actually, if you see the white line here, that's how the This is the JP Morgan Asian Investment Credit Index. And this orange line is, the global bond index. You can see that, I mean, both done pretty well, but you can see that, Asian investment grade credit actually done a lot better. And that is because during this time, exactly same scenario, expectations of the Fed to cut the rates, but the Asian banks went ahead first. And because of that, that puts Asia in quite a positive light because, they kind of like are seen as improved funding environment versus, what's going on in the US. So this is actually something that's kind of like relatable, to what's happening. Now, this is actually the GDP forecast, from IMF. So if you can see, this orange line is actually Asia. The gray is China. Okay, and what you see below is actually developed markets. So I think no surprise there. We all know that developed markets, usually the growth rates at this juncture right now coming out of COVID is a little bit more lower. Asia is always like, the super engine there. But for China, I think in the past, it is higher actually, like 7 to 8%. But Asia still is in the bright spot in terms of its growth prospects, as you can see here, even from IMF predictions. And also, right now, in terms of all these deglobalization, China plus one, all these acronyms coming in. So I think the situation in China right now, they are kind of losing a bit of their share of the world manufacturing imports and exports there. And the countries that are actually benefiting are, for example, ASEAN. So that, I think something went wrong with the slides here. But if you see this blue boxes there, this is actually Asian countries. The first box here is actually ASEAN. So you can see that in terms of the shift in trading patterns, the big drop here is actually China. You have actually the rest of Asia that's benefiting from this, and ASEAN is actually picking up quite strongly. Within ASEAN, you have, for example, Indonesia. They are the world's largest nickel miner, and that is the ingredient for EV batteries. So those of you who drive EV cars, I think the batteries, quite a lot of them are manufactured out of Indonesia. You even have Thailand, which is a hub for EV car manufacturing. Like BYD, for example, it's their Asia hub for producing the right-hand drives, because in China, they actually produce the left-hand drives. So this is actually something that we see the shifts happening that's definitely, benefiting for, Asia, especially what's happening in China right now. So moving along to the fund. Okay, so this is the Asia Pac Investment Grade Bond Fund that's available on Philip's platform. So in terms of the themes to actually support the Asia fixed income, so like I mentioned, so the room for rate cuts. So when the rate cuts come through, it is actually going to be beneficial even for Asian fixed. And given that some of the central banks like Indonesia, India, South Korea, etc., the rates actually are high, but the inflation is benign, is low. Kind of a very good sweet spot for them to actually consider cutting rates, because if you look at their growth actually has also come off quite a bit after, all the tightening measures there. So this is something that we see them in a good position to actually, increase. This is actually Asia's, I'm going to show you a chart in a while in terms of Asia's growth prospects there. And last but not least, China. So China, we know that structurally it's a bit of a very challenging period right now for China. But I mean, there's all these issues about their property segment and all that's causing quite a lot of pain in China there. But this year, at least, we are seeing that the government is definitely trying to see to prop up the economy there. Stimulus measures that have been actually done in January, 280 billion of stimulus packages, and probably more that's going to be rolled out into China. I mean, China is definitely a country that if those of you who have been investing, like for me, I think the last 15, 20 years when I was investing in China, usually you tend to wait for, when they want to go in, there's a bit of a correction there. And usually you just top up or you invest in there. In a couple of months, it actually kind of like goes back up. And that happens quite often over the 10 or 15 years. But this time around is very different, because after the rally last year, I think everyone's waiting for like a year or more. And, China is not kind of coming up to where it used to be. But China, I think if we see the government, what the stimulus packages are doing right now, hopefully that helps. And China is something that you do want to position in early, because when China actually runs off with the market, it's a bit too late to allocate. And right now, this is honestly quite a sweet spot in terms of where they are in this kind of levels to actually start allocating towards. So this is actually the chart I was sharing with you. So this is basically the rates right now for Thailand, for Asia. So Thailand, Philippines, Indonesia there. So we see that the inflation numbers are actually quite low. So this is a very different situation that they are in versus US. Okay, because US inflation is trending upwards. That's why the rates, they have to actually be very careful. They don't want to cut it too fast, which will then push inflation higher. But for Asia, it's different. So potentially we could see Asia actually cut rates first, and that means it will benefit the Asian bonds more. So this is actually something that we have on fixed deposit rates in Singapore. I think very similar to what Alice has shared earlier. So basically, right now we are also at a turning point. I think those of you who actually put your money in fixed deposits, comparing around the banks who's offering the latest highest FD rates, you will notice that comparing from last year to this year, your rates probably have come down. So if you're renewing them, chances are you're not getting the lovely, 3.9 or 4% rates that you used to get last year. And it's probably going to get cut even further because as we go into second half, if the rate cuts come, you probably want to start looking for alternative, solutions when the rates come down further. And honestly speaking, for bonds, generally comparing to equities is relatively less volatile. So that's something to consider with the dividend component as well. Okay, so this is actually the rates that bonds actually have. So if you see on the right side, okay, this is actually your Asian bonds. They tend to have definitely higher real yields versus on the left, which is predominantly your developed markets there. Now the story about I'll just skip this and come back to this here. So the thing about Asia is this. You probably hear a lot of presenters, on top of me today, talking about Asia. Asia is definitely something to look at. And it's probably the same thing you hear for the last 10 to 15 years. Now, this is actually factual data here that's coming out, from the World Bank. So if you see this gray bar that consistently outperforms the rest, that's actually Asia. And that's the Asian actual GDP numbers there. If you look at it versus the rest of, like the world GDP, the US GDP, Europe, etc., you can see Asia consistently outperforms. I mean, everyone is up positively, no doubt about that. It's just that Asia, because they're still growing, and growth is not something that happens overnight. No, it's not a 1 year or 3 year thing. It's something that takes decades. As hopefully one day Asia, almost all of Asia can get classified as developed markets because it's not there yet. But you can see Asia's growth over the years and probably over many times you hear presenters present has been very strong. COVID especially is something really interesting. If you see here, this is actually positive, and that's Asia, the only region that's positive. The rest are all, of course, you know what happened to them. But even going forward in terms of the GDP forecast for Asia, we do foresee that it's going to be strong in terms of the growth potential there. The other thing is also investment grade. So Asia is definitely, it's not totally developed market yet entirely. There are still some countries that are in the higher territory. And honestly speaking, from where they were before, you can see that Asia is definitely on its way up to the developed market, region or classification. So this line here actually distinguishes between investment grade bonds and non-investment grade bonds. So non-investment grade bonds, another word for it is high yield, okay? And this is your minimal is BBB minus. So you can see that how you interpret this, the blue square is basically the credit rating of the various Asian countries 10 years ago. The green triangle is basically the credit rating right now. You want to see the green triangle above the blue square. Okay, and you can see that's been happening. Of course, except for China and Hong Kong, which we know the situation there. But the rest of the Asian countries, you can see, they have actually upgraded in terms of the credit quality. In fact, for countries like Vietnam, although Vietnam is within the higher space, but they are progressing. You can see the green arrow is getting near to the borderline to get into investment grade territory. Who knows, maybe in a couple of years. Vietnam is something quite popular. I think there's a lot of attention about the growth prospects for Vietnam, but it has not made its way into the benchmark yet. But definitely for us, for fund managers side, we can get into some names. We do have that ability to maybe allocate more than what the benchmark has. as long as we are constrained by or we are kind of within the limits of the tracking error. Now, if you see here for Indonesia, I think Indonesia has been doing pretty well. So you can see that they're now in the investment grade from, just below investment grade right now into the investment grade territory. Philippines as well, India. So, a lot of progress that the Asian region has made over the last, couple of years, as you can see. And of course, Singapore, as we know, AAA rated across all three agencies. Now, emerging markets, right, is big, and Asia is part of emerging markets. The other part of emerging markets is Brazil, Turkey, Russia. So those of you who invested in BRIC before, if you notice, the green triangles are actually down. It's not been actually, it's not been doing too well, quite volatile in this area. But the fund that I'm sharing with you on is more on the Asia side. So this is something that is doing pretty well there. Some of the countries that we like within Asia. So for example, Indonesia. I think let me just share with you a little bit on what's been going on in Indonesia. Indonesia does have its goal in 2045. They aim to be a high income country, a high net worth country. And Indonesia, actually, if you see in terms of the quality of the labor, it's definitely improving. A lot of them are educated now. And, definitely the quality of the labor is there. And that also sparks increase in domestic consumption as well. So you hear a lot of good, stories coming out of Indonesia from domestic aspect. I think even from government aspect, you can see definitely the government is very well structured right now. So like even for Jokowi as well, he's always looking for, opportunities to grow for Indonesia. I read one piece of news that given what's been going on with China, they are losing their share in the world stage. They are not, of course, with all the trade tensions there. Russia, of course, with all the issues going on with their geopolitical problems. China actually reached out to Indonesia with Jokowi to see if he want to be part of the BRICS. Okay, and the other thing also, I think EV is a very popular topic, especially in these couple of years. So Jokowi obviously got wind that Tesla was actually looking for another place to have their production hub. So Tesla is actually right now in Fremont, California, Shanghai, Texas, and outside Berlin. And they're looking for one more place to build their production facility. And I was sharing with you earlier, Indonesia is known for their nickel mining and their EV batteries manufacturing there. So he's actually gone to visit Elon Musk in the SpaceX headquarters in Texas twice. Obviously wooing him with tax incentives and all to see if he can get Tesla to come into Indonesia to actually build up the plant there. So, a lot of interesting things, coming out of Asia, especially countries like Indonesia that we see has definitely evolved and changed from what they were previously. Even for India as well. So this is another territory that we like. I think India has definitely come very far from where they were 10 or 15 years ago. They are now getting into most of the benchmarks there. They weren't before. So India, definitely third largest economy in the world. Sovereign rating is very stable right now for India. In the past, India is very prone to inflation because they were not very domestic dependent. They were very much, they import a lot of things. And that means that when prices are high, the imported inflation comes in. Not good for them. But because right now with how India has actually kind of structured their whole economy, so like foreign companies coming into India, of course, there are tax incentives and all, but they do have to partner up with the domestic companies. So there's all these things that's definitely helping putting India in the spotlight there. And as you can see, inflation definitely a lot lower than how they were. I've handled India for like 15 years. So I have seen India every time hitting inflation issues, but this time around it's quite remarkable how, everything is very well structured, which is another territory that we like. Moving along. So sharing a bit on the Manulife Asia Pac Investment Grade Bond Fund. So this is Asia. So Asia definitely you need more boots on the ground, more research definitely. So for Manulife Investment Management, we do have quite good presence within ASEAN, especially like even Indonesia and Vietnam and Philippines, to make sure that our on-the-ground analyst knows the markets well, knows the companies that they're covering well, to actually then feedback or to basically work with the fund managers managing the fund. So this is the fixed income team for Manulife Investment Management. So very, very big. Our head of Asian fixed income actually sits in the Singapore office. That's Marie over there. So a bit on the fund, the key highlights there in terms of the guidelines. So if you see for this fund, Manulife Asia Pac Investment Grade Bond, I'm going to call it MAPIC for short because if not, it's quite a mouthful. Okay, it goes minimally 95% into Asia Investment Grade Bonds. So minimally 95%. The maximum we can go into high yield bonds or non-investment grade bonds is 5%. So you can see it's a very, very high quality bond fund that high quality bonds that we get into. Because of this guideline, we are also CPF, OA, and SA included as well. So other than cash, SRS is also under the CPF. Currency exposure wise, we can go into local Asian currencies where we can, but right now at this juncture, because of volatilities in the market, we are 84% into Sing dollars. So I think the previous speakers talked about duration as well. So I think for duration, we are at the upper limit of our duration limit, which is 5 years. So the fund is about 4.5 years in terms of duration there. So nicely in the sweet spot in terms of when rates actually are going to be cut. This kind of a duration length is ideal. The fund pays monthly distribution, 4.09%. So previously, our dividend is actually quite stable. So in the past, it's been 3.6. But sometime late last year, because of the elevated yields, we also are able to pay out more. So we actually pay out 4.09% every month. So the size of the fund, pay about half a B, okay, and our yield to maturity is 5.82. So of that, we pay 4.09 out, and the rest we put it back in. Okay, so this is the currency position. Okay, so mainly in sovereigns and corporate IGs. And as you can see here, quite widely diversified across the various Asian countries there. Okay, so you probably see China here 20%, but we are underweight the benchmark because the benchmark is about 28. Okay, so China actually, I guess the next question usually I get asked is property, how much? Okay, property is actually only 0.8%. So we are actually quite well diversified out across China, manufacturing, online marketplace, okay, technology and all that. So it's definitely a wide spectrum of China opportunities, and property is only a very small aspect of it. Actually, one myth to actually kind of debacle around China. So whenever you see a fund, you see China, you tend to think, is it actually, you tend to stay away when you see, it's such a high composition there. But do remember one thing, China investment grade and China high yield do behave very differently. And this is actually a chart from Bloomberg to show you in terms of the benchmark. So this black line here is actually the benchmark for JP Morgan Asia Credit Index. So it's your broad Asian investment grade bonds. That's the black line here. The orange line, right? Guess what? That's China investment grade bonds. So actually China investment grade bonds, not bad. Okay. So anything from China is not bad actually. The one that you see that's coming down, crashing down, and that's probably causing volatility in the funds that may be holding on to it, that's China high yield. And that is the one that if any of the funds do hold some China high yield, that is what is causing the volatility then. Okay, so I thought I'd just resolve that. So this is the performance of the fund. Okay, so most of the time periods we outperform our benchmarks there. So year to date basis, we are up about 1. Benchmark is about 0.17. Okay, so this fund honestly is more stable in that sense for your portfolio. It's Asian investment grade, gives you that 4.09% dividend of its CPF. So, it's something that's, I guess, very cushiony in the portfolio there if you're looking for something to get exposed to Asia, the upside for Asia. Of course, Asian equities can be more volatile, right? But this is another aspect of Asia that, you can look at, for your fund, for your portfolio. So this fund also is a very popular fund within asset allocators at the major financial institutions here. So when they tend to allocate into Asian fixed income in the portfolio, this tends to be one of the popular choice for them to as part of the building block. Okay. So I know I'm running out of time. So this is just some of the awards and accolades that the fund has won. Okay, this is from the Asian Fixed Income team. And if you want to know more about our capabilities or our solutions, you can actually point your phone to here to the QR code to go to our website. Okay, with that, thank you so much for your time.
Okay, thank you to our three speakers for giving us their takes on the fixed income industry. So if you have heard everything, there are some views which align, some views which are slightly different, nothing wrong. Because even your Fed committee members, they each have their own different opinion and views. That's why you got so much mixed signals, right? Okay, so we are going to Q&A. I think there are some questions compiled over the past 1.5 hours. Okay, so I think the first question is directed to PIMCO. They're asking about the MBS. Is there any difference from the subprime in the past? Yeah. Okay, Alice can take the question.
Okay, so question on whether it's the agency MBS I talk about, is it the subprime mortgages? Short answer is no. There are different instruments because agency MBS, these are all backed by what we call prime loans, not subprime. Okay, so, and it's very important to notice, to actually understand that since the 2008 financial crisis, there actually has been no more issuances of subprime loans because obviously the regulators learned the lesson. So they actually clamped down on the mortgage industry very tightly. And from 2008 onwards, or rather 2008, 2009 onwards, all of the homeowners, they are only allowed to take out a mortgage if they satisfy very stringent criteria. So these are what we call prime mortgages that get added into or get packaged into the agency MBS that I talked about earlier. Now, I just want to highlight that the PIMCO Income Fund does have a very small allocation, currently about 9% of the portfolio in non-agency mortgages. So these are actually backed by subprime loans. But very importantly, these subprime mortgages, while they are subprime, they are actually very different from the subprime that you remember from 2008 because these are the surviving mortgages. So imagine these are, I mentioned just now, no more subprime mortgages issued post 2008. So these are actually based on whatever subprime mortgages that we are currently holding in our fund. These are actually homeowners that have continued to service their mortgage from 2004, 2005, 2006 until now. So they actually have been paying down their mortgages for 20 years, close to 20 years. And what are the chances that a homeowner has been paying his mortgage for 20 years? One day he suddenly wakes up, I'm not going to pay my mortgage anymore. Quite low, right? And because you have been paying your mortgage for 20 years, your mortgage value has come down. After you service your mortgage for 20 years, I'm pretty sure the loan outstanding is quite low. On average, the subprime mortgages that we hold in our portfolio, the loan to value is only 50%, meaning if your house is worth $1 million, your loan is outstanding is only 500,000. That's very important because if your loan outstanding is only half of the value of your house, again, chances of you defaulting on your mortgage extremely low. Even if you lose your job, you would rather sell your house and cash out the 500,000 than to default on your mortgage. So that's why even though we do have both prime and subprime mortgages on our portfolios, both are very high quality. On the agency mortgage side, backed by prime loans and government guaranteed, even the subprime that we hold in our portfolio, very low loan to value ratios, very resilient, time tested throughout the 2008 crisis, and even though they are in nature subprime, but very high quality holdings that can provide very resilient and very stable cash flow.
There's another question for PIMCO as well. What is the average duration of the PIMCO income?
Average duration. Okay, so that's very interesting because I know that my two other speakers, Leonard and Sabrina, talked about how having duration is very, very good in this kind of environment. Currently, I think among the three funds, we have the lowest duration. We are at 3.5 years of duration in the portfolio. Why is that the case? And that's because, again, our views at PIMCO are differing from the market consensus currently. You may recall just now I mentioned that our view is that the Fed is probably going to cut rates either at the end of this year or into 2025. That means that we currently don't actually think that it is time to add that much duration in the portfolios at this point in time. We think that at some point, if you look at the current yield curve, longer dated yields are actually lower than the shorter dated, right? So we think that right now taking too much duration doesn't really benefit because you are taking on higher interest rate risk, but not compensated for it. That's why right now we're preferring to stay slightly shorter in duration at around the 3 to 4 years mark. So that's where our view differs slightly from other assets.
Okay, one more question for Alice. Burning questions. Okay, so what's the driving force for USD strengthening in 2024? Strengthening of US dollars.
Well, that's again, I think that ties back to our view, right? I think it actually is a proof point of our view that we think the Fed is unlikely to cut rates and as soon as what markets expect. Because if the Fed starts cutting rates, that's when you would actually see the dollar weakening. But again, because we think that the Fed is likely to cut rates further out the horizon, that lends continued strength to the US dollar.
Okay, thank you, Alice. So I think the next few questions also directed by Leonard also. Okay. Yeah, let's see what will be the first question for Leonard.
I don't like that laugh.
Okay, I think someone asked like, do you feel like maybe the US investment grade, like it's like overvalued, or is it maybe too late to get in? Is it something that you still recommend?
Okay, that's a good question. If you take a look at investment grade, so basically we use that to refer to bonds that are issued by companies. So we do think that investment grade overall market looks a bit expensive. So basically how we tell whether something is expensive or cheap, we compare how much additional yield you are getting compensated versus government bonds, which are typically used as a reflection of the safest parts of the market. If you look at the overall investment grade right now, the market, you're getting maybe about 5.5 to 6%. You compare that to where US government bonds are giving you today, it's very attractive at between 4.5 to 5. So the additional compensation that you are getting from buying bonds that are issued by companies instead of governments, that doesn't look to be as wide. Basically, you're not getting as much compensation as you used to have back in history. So overall investment grade looks a little bit expensive. And that is also one of the reasons why our portfolio right now, you see more than 50% of it is in government bonds. Investment grade bonds, we are being very, very selective. So we are not just buying all the bonds out there in the investment grade market. We do see some opportunities in financial. So basically banks that are issuing investment grade bonds. These bonds are giving a bit more of an attractive yield relative to the average bond out there in the investment grade market. So we are being a bit more selective, choosing some of these bonds that we see has attractive value. But otherwise, overall, our portfolio is quite defensively positioned. That's why you see we do have the majority of the portfolio allocated towards government bonds at this current stage in time. So maybe I would just also like to share that, I mean, if you want to think about how our portfolio is positioned, for those of you who managed to join us in person, look at the premium that we have chosen to give you today. It's our umbrella, and we like to use that to represent the fund because regardless of whether markets are doing well or going to be going towards a sort of like a more risk-off kind of a sentiment, an umbrella is always going to help you protect from the shade or also from the sun, from the hot sun. So regardless of whether it's raining or whether the sun is too hot, you're going to be able to have that to build some resilience in your portfolio. So just think about that if you can't sort of remember anything that I mentioned about during my session just now.
Yeah, so another question related to currency. So USD may appreciate or depreciate, right? So what's the impact on US dollar on your fund?
Actually, our fund, like the name suggests, right, US dollar bond, we tend to run our currency exposures via the USD. Our view is also that the USD may maintain its strength, at least for this year, simply because of where the interest rates are relative to the rest of the market. For example, if you take a look at where market thinks rates are headed towards in other parts of the world, like Europe. We do think that Europe will cut rates earlier than the US, and this is also going to be another tailwind for the US dollar. So I would say overall, we do think US dollar is expected to remain relatively strong at the current levels, and especially when we compare that to other currencies. So that's our house view.
Okay, one more question for Leonard. I think you have a 6% class and a 4% class, correct? So what's the risk of the 6% one over the 4%? I think they are assuming, are you going to pay out of NAV, something like that?
Yeah, so we do have two share classes. So the first share class pays out 4.5%. This is the natural income of the portfolio. So basically the portfolio of bonds that we hold, if they are giving us around 4.5% of yield, that is what we pay out to investors without touching into capital. We set up the 6% share class because we understand there are clients who are really looking to maximize the monthly income payout. They want to see a higher dividend amount credited into their account. They are not so concerned about capital growth or seeing the unit price go up as much. So the 6% gives us the opportunity to tap into capital. If we can generate capital gains, for example, trading in and out of the market, we can also tap that on as another source to pay a higher sort of a dividend to clients over the 4.5% natural income. So it's just two share classes, depending on whether you are okay with the natural income or you want to maximize the monthly income payout, then that's where you can choose between the 4.5 or the 6% share class.
Okay, thank you, Leonard. The next two questions, all Asia related. Sabrina, your turn. Okay, let's see. China's interest rates are already low without much room for cutting. So are Chinese bonds a good buy?
It depends on your risk profile, but I think China right now has honestly a historical low. So we don't know how long it's going to actually be staying on this period, to be honest. But if you do have a 3 to 5 year horizon, I mean, China is definitely at this level something that you can start to position in.
Okay, many Asian currencies are depreciating a lot. So how do you address the currency risk for your fund?
Yeah. Okay. So for us, right, we go into US dollar denominated Asian bonds. Okay. So the local currency aspect of it probably less so unless we want to take any active currency view. But what we do is when we get into these US dollar currency bonds, we hedge it back to Sing dollars. So that's why you saw earlier 84% is in Sing. Because this fund that I was sharing is actually a Sing domiciled fund. It's an authorized fund. So, with the interest of mainly Sing investors in it, so definitely that's, a kind of a safer position that we take with it. So active currency positions, quite little at this juncture.
Okay, why is your fund duration limited to 5 years or below 5 years?
Why is it 5 years? Okay, I mean, that's the investment guideline for the fund. So I think that's where the sweet spot is. Anything longer than that, I mean, we do run another fund called the Manulife Singapore Bond. That one can go up to 7 to 8 years. Of course, in the last couple of years, that kind of length of duration was not exactly the most attractive, right? But we do have other strategies. It's just for the Asian investment grade one, we felt that 5 years was actually a good reflection across all the countries in terms of the maximum duration we want to get into. Yeah, so if you are looking at a longer duration, we do have actually another fund that gets into that.
Yeah, I think that's all the questions for today. There are quite a few questions asking on like investment related matters, like what's the NAV for all the funds, or what's the annual management fee for all the funds. So I think for these questions, right, I think please do seek out your personal advisors, yeah, or maybe you can reach out to us individually later on. Okay, yeah, I think there are some questions on allocation as well. So same thing, I think please seek out your advisor on this, right? I think today is more of like a market outlook sharing. Yeah, I think without further ado, I think that's it for today. Yeah, thank you for the 3 speakers and thank you for the audience for your time coming down on Saturday. Hope you got something away from it. Thank you. Yeah, there's still a lot of food left, so please feel free to take some home.
Recordings.